that 2016's bottom is in place, and maybe for the next couple of months with all the central bankers in a mood to print more money, we could see more upsides?
Yeah, look, it's extremely difficult to assess the bottom here, given the number of moving parts and the number of factors that could change literally minute by minute. So to that extent, I wouldn't second guess where the market is going. What would be a useful assessment is how have prices behaved, how have valuations behaved, given the changes in earnings estimates that you would have to make. To that extent, yes, the market is relatively more attractive than it was, say, a couple of months ago. But I won't hazard a guess whether we're close to the bottom or not.
Yes, that is a million-dollar question. Pramod, hi, morning. But what have you made of the earnings season so far?
The earnings season is pretty much in line with what we were expecting. We have been highlighting consistent and sustained downgrades to consensus estimates for the Indian market, and that's playing out in that direction. What we are worried is we are not seeing any sort of bottoming out in that downgrade cycle. We're likely to see a few more, particularly given what's happening in the banking sector, where there seems to be some sort of urgency to clean up the balance sheets. Now, that's likely going to have an impact on banking earnings, no doubt, but it's also going to have a rub-off effect on the rest of the market, particularly rate-sensitive, capex-intensive sectors. So yes, it is weak as expected, likely to remain weak going forward as well.
So what would you latch on to? You said that the only thing positive about the fall is that valuations are attractive. Where would you place your bets?
Yes, I mean, it's better to work with a bottom-up approach in these sort of times, because we've highlighted India itself, amidst this global turmoil. India itself is going through some readjustment in terms of the drivers of the economy. To that extent, it's very difficult to play it top-down. Consumption is affected, given the reduction in subsidies, given the reduction in government spend, the sort of fiscal consolidation that we've seen in the banking system's situation also meant that capex and investment demand is affected. So they're not really any sort of secular or clear-cut top-down stories that you can place. What we are pointing investors to is, if you've always liked certain bottom-up stocks with good quality managements in areas which are by and large immune to the macro, they have their own drivers of earnings going forward. The only thing holding back was the expensive valuations. Now that's less of a worry. So those are the sort of stuff that you like to buy post the events of this month.
Okay, I understand that it's hard to call a bottom in this market, Pramod, but do you think that the bull market in India is still intact?
I mean, it's tough to define where you started for the bull market, but yes, given what we've been saying over the past 18 months or so, there's been a massive readjustment of the economy from a subsidy-driven consumer spending to a sort of anachrony capitalism-driven capex spend to a much more sustainable base that is getting formed. Having said that, the short-term effects of such a restructuring of the economy is likely to be negative, the way we've seen the impact on corporate earnings. Like I said earlier as well, it might linger on for a bit. But what it does is it does lay the foundations for more sustainable growth, less inflationary growth going forward. But of course, we also have to expect a certain benign environment in terms of global factors to support that as well. So I would be interested in Indian equities for the longer term, given the sort of these changes. But now whether that classifies as being hopeful that the bull market will sustain or not, I'm not sure.
How long is the long term?
I think anything over a 2 to 3 year time frame is definitely looking positive. But like I said, it all depends on how the global factors are also aligned to support this sort of a positive trend for India.
Okay. Well, can you size up the gyrations in the global market, Pramod? At the end of this rather tortuous 3 weeks of January, where are fund flows headed? Will they look in India's direction? Will they even look in EM direction?
EM certainly not. India possibly so. But to the extent that we've seen the sort of decoupling between India and perhaps a couple of other markets with the general emerging market asset class over the last 18 months. If you remember, emerging market as an asset class have seen outflows for more than 2.5, 3 years now, whereas India has only begun to see that effect only over the last 8 to 9 months. That means that for a good period, say between early 2014 to mid 2015, we went against the direction of those flows, which also meant that our weight within the emerging market holdings of EM investors went up consistently. To the extent that I don't think EM investors could justify increasing that weight anymore, and hence as a result any further outflows from that asset class would mean that India also had to participate in those outflows. That's exactly what we've seen over the last 8 to 9 months. Nothing's changed in that dynamic. So if the asset class as a whole continues to see outflows, we're likely to be seeing part of that selling as well. One positive thing could be if India, if global investors sort of discern India as a relatively more attractive market, maybe there could be more positive inflows to country-specific products or India-specific funds. But that, as we know, still remains a smaller portion of the larger pie. So overall flows-wise, I think we still remain negative.
Okay, very quickly then, we just saw the Axis numbers. What would be your take on banks? Private banks in particular, but all banks.
I mean, banks, like I said, we are seeing some sort of action from the RBI in terms of a sense of urgency to clean up the balance sheets, and rightly so, so that we are in a position to kickstart the investment cycle without the banks participating in credit growth. That's unlikely to be the case, and hence, as a result, this cleanup perhaps mandated. Now, given that, I think there is another 3 to 4 quarters of impact in terms of credit costs for the banks on earnings. So to that extent, it would be better to stay away. But there are a few who are exceptions where we think that the market action or the price action has been a bit overdone, and valuations give you that sort of margin of safety to live through these 3 to 4 quarters of higher provisioning that's expected. And you mentioned Axis. Axis perhaps one of them where we think that the risk reward is favorable for the investor.
Okay, on that optimistic note, we let you go, Pramod. Thanks for joining us. That's the word coming in from Ambit, but we need to move on. Persistent Systems delivered a good set of numbers.